Hello bulls and bears, welcome back to my channel Stock Rumors. My name is Andy and today I will teach you how to average down the price of your stocks. Now we'll discuss if that's a good idea and if you should use that strategy or not. But first, let's discuss what averaging down means. This is what it says. Average down or averaging down refers to the purchase of additional units of a stock already held by an investor after the price has dropped. So you buy a stock at a certain price and the price drops. So what do? You buy some more. Averaging down results in a decrease of the average price at which the investor purchased the stock. This is an investment strategy that involves buying more of a stock after its price declines, which lowers its average cost. Okay, so if the price drops, instead of selling it for a loss, you buy some more, which will reduce the price that you paid for the whole amount of shares. Now, if you're a visual person like me, don't worry, I'll show you. So let's say that you buy 10 shares at $10 each. So that's $100 for those 10 shares. Now later, the price drops to $8. All right? You paid $10 per share, but now the price drops to $8. That means that your equity is now negative 20 because the 10 shares now at $8 each will be $80, right? So you're down $20. Now what do? You decide to buy 10 more shares at $8. So now you decide to go ahead and buy 10 more. So that's $80. Now the original shares you paid 100 and the second set of shares is 80. So in total you have now $180 for 20 shares, right? Now let's say that the price bounces back up and it goes to $10 again. So now you have 20 shares, right? You have 20 shares and the price goes back to $10. So that is 200. So you paid for the 20 shares 180, but now you're up $20 because now you have $200 worth in shares. So you can average down the cost of your shares and then make a profit. So if you didn't buy the extra 10 shares, right, this is what would have happened. So you buy 10 shares at $10, that's 100. The price drops to $8, right? So you go down to 80. Then it goes back to 10. So you break even, right? But if you buy the extra shares at $8 per share, then you're making a profit. So you can see that it is a good strategy, but this is what happens. What happens if you buy 10 shares at $10 each, then you buy another 10 shares at $8 each, but the price continues to go down and it goes down to $6. What do? You buy more? Well, if the price keeps going down, you have to keep averaging down or take the loss. To summarize everything, averaging down is a good strategy if you know that the price will rebound, that the price will go back up. But if you bought a really bad stock and you're not so sure, it's better if you exit that trade. You wait for the stock price to continue to go down and then you could buy at a lower price. Some people, let's say, have only $200 to invest, right? Because they don't have a lot of money. Now, what they do, they invest the whole amount. So they don't have a reserve to buy more stocks in the case that the price drops. So you shouldn't invest all your money. You should invest gradually. That will give you room to average down if you have to. In case the price drops, you will have money to average down the overall cost of your stocks. Don't invest at all. And that could be said even if you have $2,000, even if you have $20,000. You don't want to invest at all because you could get stuck. Because if the price continues to go down indefinitely, you will have a big loss. So do not invest all your money at once. That's my advice. So if you know that the price will rebound and go back up, go ahead and average down. If you think that the price will continue to go down, exit the trade, and later if you want to, buy those shares again at a lower cost. But don't invest all your money at once. So this is a strategy for averaging down your stocks. I hope you understand better now. If you found value in this video, please go ahead and hit that like button. Don't forget to subscribe to my channel for more strategies and videos like this, and I'll see you in the next one.